Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 4th of June, and we've Brent crude oil trading at 77.37. So sort of steep declines, I suppose, was the only word to describe it since the decision at the OPEC meeting on Sunday. But one would also have to caveat that by saying this has been a downward draft for 2 months now. And perhaps the OPEC meeting didn't do anything to stop that downward draft, or did it indeed accelerate it, perhaps? Let's welcome Neil Atkinson, former head of oil markets division at the IEA, sitting in Paris. Neil, your thoughts now 2 days after the OPEC meeting, a bit of time to digest the announcement. Why do you think the oil markets are responding bearishly?
Well, I think there are various factors. Number one, I think the outlook for demand growth is weakening as time goes by. There's still growth, still plenty of growth, but it's likely to be less than we thought at the beginning of the year. You know, there are weak signals from China. There's some data came out yesterday about diesel demand in the United States, which is very important because of the huge swathes of the economy which use diesel. So on the demand side, the sentiment is a little weaker than it was, but there's still growth. On the supply side, of course, we've still got plenty of increases from the non-OPEC countries, the United States, Guyana, Brazil, Canada, and others. And although demand in the second half of 2024 is likely to be significantly higher than it was in the first half, because of this increase in production from the non-OPEC countries, there's very, very little headroom for the OPEC Plus alliance to supply more into the market if they want to. And, overall, the market is becoming sloppier. And OPEC have said that they're going to relax or unwind some of the cuts in the later part of the year. But I think people should read the bit in the statement which says subject to market conditions, or whatever the exact wording is. So it's not a given they're going to add more supply to the market. But overall, the sentiment is getting less positive if you're looking for higher prices.
Pamela Munger, senior market analyst at Vortex. Pamela, your thoughts, what you can tell us, what you see in the shipping lanes of the world that give us some sort of clues as to the scale of demand out there. We are seeing oil, crude and products spending a lot longer on the sea.
Yes, certainly, and what we're noticing, and just kind of bouncing off Neil for a moment, I agree with everything that he said in terms of the demand outlook. So not just at sea, but with our combined onshore inventories and our seaborne imports, we can create what we call implied refinery runs. So we get a really good idea of what's happening in China before it happens. And we've been noticing this very essentially poor demand in China for crude, for refinery processing, which has resulted in what we see as announced run cuts and lower margins. They don't have much of an export market, or they don't refine in order to export. So you can also see their stocks building. And also just in general at sea, you see very high oil products at sea. So moving back to the clean product side, Russia is having a lot of trouble finding homes for its barrels after some of the newer, stricter sanctions on financial institutions, on ports, on specific vessels. You see a big buildup of oil products at sea, in addition to the additional time it is now taking to move around the Cape of Good Hope instead of going through the east of Suez for all of those Middle Eastern clean products as well.
Clyde Russell, Asia commodities and energy columnist at Thomson Reuters. Clyde, your thoughts, again, similar to Neil, 48 hours after what was a fairly complicated set of OPEC announcements. We had 2 press releases on Sunday, one from OPEC as a whole, OPEC Plus, another one from the OPEC plus 8 countries. All of them contain many different things. Clyde, your thoughts as 2 days later, why the market isn't responding bullishly to the news?
Well, I think you got to boil it down to the one fact that as it sort of appears, OPEC is intending to, whether it will or not remains to be seen, but it's intending to put more oil into the market from the fourth quarter onwards. If they would be doing that on the belief that they think demand is going to be strong. Remember, OPEC's demand forecast for global oil growth this year is 2.25 million barrels a day. That's a lot. So, their voluntary cuts are 2.2 million barrels a day of the 8 members making those voluntary cuts. It's probably not a coincidence that, those two numbers are pretty close to each other. So if you are OPEC, you're effectively taking a bet that demand is going to recover strongly in the second half. And then you can capture some of that increased demand and maybe try and put a little bit of a squeeze on the people who've been taking your lunch, like US shale and perhaps some other American producers or producers in the Americas. So that's probably what OPEC is thinking. They definitely want to keep that price above 80. They'll be disappointed that it has, the market has not kept it there. But that's kind of what they're thinking. Because, I imagine if you're Saudi Arabia, the calculation is it's better to sell 8 million barrels at $80 a barrel rather than 10 million barrels at $60 a barrel. But if you really wanted to kickstart demand, my feeling is that oil prices have to be substantially weaker than what they are. If they fell to $60 a barrel, that would solve a lot of the sticky inflation problems that the Western world is having, and it would also kickstart demand in the developing world. I don't think OPEC will do that.
Just to pick up on that point, because I wanted to follow up on it, is Chinese inventories. If oil was $50 a barrel, would China have space to store it? There's a lot of, besides the idle supply that is a downward draft on prices, perhaps, but also the fact that Chinese inventories are very full.
Well, Paolo's probably got as good an idea on Chinese spare capacity to fill storage tanks than I have. But what always surprises me is, if oil is cheap, China buys it. And that's just been a historical fact. Are they really running out of space to store it? Probably not. I think they've probably still got a capacity to store quite a bit more, especially in commercial inventories rather than strategic reserves. So I think that probably, if oil did fall, they would buy more. But that's what you really be hoping for if you did have much weaker oil prices is to really give demand a kickstart. And sort of get the economies working again. And that's something that you see. If you look across Asia, there's only really one major economy that's firing on all cylinders, and that's India. The rest of the region is sort of very muted. I know people talk a lot about demand. I focus a lot on imports. And if you because I believe seaborne imports ultimately drive the price. So if you're looking at Asia's imports so far in the first 5 months of the year, they're only 100,000 barrels a day more than they were in the same period last year. That's hardly any growth at all. So you've really got, the world's top consuming region having very, very lackluster growth in imports. And I think, I'm not sure I believe that OPEC will put more barrels back in the market because I'm not sure the demand is going to recover as strongly as they think.
Neil, as a former head of oil markets division of the IEA or any agency for that matter, it must warm your heart to see such granular details, data like OPEC put forward yesterday. My thoughts, Neil, that level of granular transparency, as it's generally referred to as, may in itself be kind of bearish. The unknown tends to elevate. The very specific outlook tends to, like any transparency, tends to lower the price. Your thoughts on OPEC making this move towards such a very granular level of detail, transparency detail, and out for 15 months?
Well, I've reached the age now where it takes quite a lot to warm my heart. I can assure you, OPEC's complex quota system doesn't really get me going.
Finding a barrel in a remote pub in outer Mongolia. That's
well, I'm always on the hunt for for stocks for countries that have got bloated stock holding and they're using barrels and pumps. No, the point is this. I'm old enough to remember the good old days when the modern quota system really first got going in the early 80s, 1983. And that was simply a question of they came up with some numbers. They said country A will produce this, country B will produce that, blah, blah, blah. And then you spent the next few months looking at primitive tanker tracking systems to work out who's cheating and by how much. But of course, these days it's got far more difficult because of the concept of voluntary cuts and the phasing of cuts. And I don't think OPEC and OPEC Plus are actually helping themselves very much by having this extremely complex set of production targets. Quite frankly, it's constructing tables and charts to illustrate this has become very, very difficult. But having said that, when you do cut through all the verbiage in the communique and do actually look at the numbers, as Clyde was just saying, they say they may be unwinding cuts in the later part of the year, and they say this and they say that. But frankly, OPEC Plus has very, very little control for the reasons we discussed earlier on, weaker demand growth, but still lots of non-OPEC supply. So their scope is very limited. Yes, they put it all out there in a statement and there's loads of numbers you can chew on, but unless demand growth remains at the kind of levels that they would prefer, and unless the non-OPEC production growth is more restrained than they currently expect, they have very, very little headroom. And I've used this phrase on this podcast many times before. We all understand producers have feelings as well as consumers, and we all understand that they need higher prices to meet their budgets and to meet the requirements of their long-term investments as they try to diversify their economies. But they are going to have to suck it up. That $90, $100 a barrel, which some of the more excitable analysts were talking about earlier this year, is just not going to happen.
Pamela, just picking up on that point that mentioned Neil or Clyde mentioned, and we were talking about is the inventories, where we see global inventories. I mean, this market is well supplied. There's a lot of inventory on the water, as we said earlier, because of the longer routes around the Cape of Africa, but also in the context of China, lots of storage. What is Vortexa seeing from that point of view, and particularly from a China perspective?
Yeah, good question. So our Chinese onshore crude inventories, we're showing them reaching similar levels to last year, which is above the seasonal range and above the 3-year average. And stocks are building. So stocks are building at a time when refineries are supposed to be coming off from maintenance. So they're supposed to be returning back online. You would expect naturally inventories to be drawing down, not building. Shandong onshore crude inventories we track separately, and those are well above the seasonal range for the last for this particular last year. Those refineries are doing even more poor, shall we say, than kind of the main refineries. And the other thing to mention as we talk about these production cuts, or rather the possible reversal of, especially from Saudi Arabia and the United Arab Emirates, what we can see from a seaborne perspective, we can see that, yes, there were lower seaborne exports from Saudi Arabia, for example, for the first 3 months of this year. But since in the month of May, those seaborne exports have actually returned back to last year's volumes. So from a seasonal perspective, those are right in line with the seasonal norm for crude seaborne exports in May. UAE, on the other hand, started the year relatively high at the top of the seasonal range in terms of, again, seaborne crude exports.
Clyde, just picking up on the earlier comment, and again, given one would sort of focus in on OPEC Plus's decisions on Sunday, the sort of resonating loudest bell, I would think, for the markets was that OPEC Plus is going to be producing more oil, not less. Everything else remained the same. Production increases start in the fourth quarter. UAE gets an extra 300,000 of production quota. So it's all about more oil. So where the supply side is clear and mapped out by OPEC Plus, obviously non-OPEC still looks relatively constrained in the US in particular. But where is the demand side halfway through the year here? Is China going to come back? Is China going to be a second half of the year going to make up for some of that big OPEC forecast of demand growth this year?
Well, I mean, I tend to be a data-driven kind of guy. So if I look at the first 5 months of the year, I know we haven't got the official China customs data as yet, but it's likely to show that China, for the first 5 months, was actually weaker on imports than it was, for the previous period in 2023. So, you've got no real strength in import growth in China. So, if you actually boil it down, the OPEC forecast for Chinese demand growth over 24 is in the order of 700,000 barrels a day. Right now, they're nowhere near that. Yes, I know that demand growth and imports are different numbers, but the other components of that domestic output, well, that's up slightly in China, but not dramatically. And the inventories appear to be building rather than drawing. So it really does come down to they're going to have to see much higher imports. I think the problem for OPEC Plus is it seems to be they're not very good at understanding the relationship between prices and demand. And I think a lot of analysts make that same error. OPEC can have 2.2 million barrels of demand growth globally this year, but it can't have it at a price of $85 to $90 a barrel. That's just simply not going to happen. It can have it at a price maybe of 65. But are they prepared to accept that? My guess would be no. So I think you've got to really factor in price. Certainly, what I see increasingly in Asia is there's a lot of price-sensitive buyers, and they will use inventories. The Chinese, in particular, if the price goes up too high, then they tend to pull back. I expect that their imports might struggle in the coming months because we're starting to see the arrival of more expensive oil into China because, it takes 6 weeks, 2 months for cargoes to be physically delivered. At the same time, the Saudis have been raising the prices of, their official selling prices into Asia. So the oil that's arriving now in June and July and August is going to be more expensive oil than what we've seen in the beginning of the year. And demand was weak in the beginning of the year, and now we're making oil even more expensive and expecting a strong recovery. Wow, we're putting a lot of hope on the Chinese, government getting its stimulus measures correct, and a strong rebound in economic growth there. Which again,
what were your thoughts on the IMF revising upwards of China GDP growth last week? Does that sort of indicate?
I think it's a whole system of moving parts. I mean, they really are expecting the property sector to finally get up off the floor. Where I do see strength in China is in infrastructure spending, sort of railways, airports, those kind of things. That's still pretty strong. There's still a lot of official sector building going on, defense installations, that sort of stuff. Manufacturing is mixed. Retail spending is not very strong at all. Exports are sometimes looking good, other times not looking so good. So, it's hard for me to say, whoa, this is where we're going to get really strong growth in China. I just don't see it happening as yet. That's not to say it can't happen, but there's a lot of things that have to go right. So I think if you're looking at the IMF forecasts, perhaps OPEC's forecasts, they're all really taking a very optimistic view of what's going to happen in China in the second half. Now, I'm not saying that's impossible and it won't happen. It may well happen, but the risks are, if you've got a very optimistic view baked into your forecasts, the risks are that you get disappointed.
Well, they'd certainly have to have a really bionic year, second half, in order to warrant that 700 average for the year. Let's go to 700 marginal growth and demand for the year, 700,000 barrels. OPEC question, or a survey question, why has oil market responded bearishly to OPEC meeting thus far? One, OPEC plus 8 countries plan to raise output. 2, global oil demand weakening, or 3, OPEC plus has too much idle supply? Why has oil market responded bearishly to OPEC meeting thus far? 1, 2, or 3, take your pick. Neil, looking ahead, of course, the outlook for on the demand side weakening. Do you expect, or do you think there could be a further supply tightening? I mean, is this just a short-term reaction? Markets are still digesting the OPEC decision, but ultimately this will come back because the second half is tighter, is always tighter. Your thoughts of the direction of travel from here?
Well, I still believe that demand in the second half of the year will be higher than in the first. I mean, it would be pretty extraordinary if it wasn't. The debate is how strong it's going to be versus the first half. I think it's still too early to say that we should be raising the spectre of further supply cuts from the OPEC Plus alliance, which I think is what you were alluding to.
Well, we are 2 months into a very strong downward draft on this oil. We're now back to close to where we started the year at $75, $76 on Brent. So we're about, $15, $16 continuous 2-month downward decline.
Yes, that's true. But again, I've never believed that $100 a barrel was ever likely this year, as some people did. And I think what we're seeing with the price having fallen back to around 80, it's just slipped below it, but to around 80 or so, is the price finding the right level based on the current market conditions. Now, if the price does slip significantly further, then yes, clearly the OPEC Plus participants have got a decision to make. Do they just sit and hope that the demand will pick up stronger than people think? Will they just sit there and hope that the non-OPEC supply growth will be less pronounced than currently people think? In other words, will they hope that something turns up? Because, if you get into this situation where you start reacting to price falls by cutting production again, we've seen from history that turns out in the end to be self-defeating, because it will have no impact on the non-OPEC producers, because most of them are producing oil, or the new oil that's coming on stream this year and will come on stream next year is a result of long-term investment projects in Brazil and Canada and Guyana, and even in the United States. The greater efficiencies that we've seen in recent years mean that the shale sector is far less price sensitive than we thought a few years ago. So, if say OPEC cuts back, well, okay, by how much? Another 500,000, another 1,000,000? What does that do? That just means they're ceding market share again. So again, I come back to my earlier statement that I think they are going to have to suck it up. Just one final point here, in case we don't get to this, is
yes, please.
The US election. And, if I were the Biden administration, and I try not to think of myself in those terms, but if I were, I would be cock-a-hoop about the fact that prices are lower than was feared. And I think that could be an important factor in the US election as we move towards November, because the fear was that if the prices had remained more elevated and geopolitical tension had had an actual impact on reducing global supply as opposed to distorting it, as Pamela was saying earlier on, then the spectre of another SPR, another dip into the cookie jar that's the SPR, might have been on the cards. But I think the fears of that, well, not fears, but the prospect of that is perhaps likely to recede.
Pamela, where are we at in terms of tanker rates and container rates? Is there any indicators there as to where this market is going? And from the point of view, I mean, oil is declining. It has been declining for 2 months now. Brent crude oil traded at $94 the first few days of April. It's now at $77. That's a significant decline for Brent. Are we seeing that reflected in tanker rates and shipping rates?
Yeah, so what we're seeing is, I mean, the freight market obviously has had a very interesting and great year this year on the first half, mainly due to the longer time it's taking for the vessels, of course, to move around the Cape of Good Hope. So it's increased ton miles. So you really see a lot of strength in the clean taker market, is really my point. And you kind of see the opposite in on the dirty market, and so you see the clean market freight rates getting buoyed by several reasons, and you see a slight downturn in the dirty freight market. Of course, this could change. Certainly, we've seen Aframaxes lose out for several reasons to Suezmaxes. So you're seeing some dynamics there. Of course, with an increase in possible crude exports out of the Middle East, you could see that buoy of VLCC rates, because that has obviously a big impact on that. If you see the TMX expansion out of Vancouver start to heat up, which loaded its first vessel last week, the Dubai Angel, heading to China. Most of those Aframaxes that are headed to Vancouver, we think will end up going into the PAD 5 refining system. However, it is more crude on the water, so as something else to look out for. So in saying that, what we are seeing some of the LR2 switching from carrying dirty to clean, which of course, as you know, has costs incurred in order to do that. So I think that's a fairly significant signal of the freight markets.
Clyde, last word to you today. One of the big arguments made yesterday on the call was that the softening of the market was because the shorts had the grip, and there was an overwhelming short on the paper market. Your thoughts on the outlook for that? Do any of these decisions in recent days affect the outlook for that structure in the market?
No, I don't think so. I think you're still going to see backwardation be the predominant theme in the paper market. I think the paper market obviously responds very quickly to headlines and less responsive to actual physical fundamentals. But I think their reaction that this was a bearish thing was probably the correct one, because ultimately the news was more barrels are likely to come into the market at a time when demand growth is still somewhat uncertain and far from assured. So that's probably what's driving it. What can reverse that sort of bearish sentiment? Well, you really, as Neil says, you really have to see much stronger demand, evidence of it actually happening, rather than people just merely hoping for it.
Yeah, I suppose that's ultimately the question. This room thinks that the bearish reaction is basically driven mainly by the OPEC plus 8 countries that announced their plan to raise output starting in October. Although it's incredibly slow raising, it's incremental. On a very extreme example, but Algeria's quota goes up 4,000 barrels in 1 month. But it's not so much the incremental. Once you get the headline out there that OPEC plans to raise output, it's inevitably going to have its impact. And as you say, Clyde, specifically on the paper markets. That's why this might be a short sell-off and then start to recover. We'll have to see as the week goes by, but we'd probably need to see some strong demand signs somewhere. The data coming out of the US at least we're in a current window where it feels like the rate cuts are back on the horizon, that the softening economy there. If we got some very ECB due to cut rates perhaps this month, as soon as this month, that could be give something as more support to this market. We're looking for direction from somewhere else other than OPEC perhaps in the coming weeks. Thank you, Clyde. As always, really great to have your insights coming in from Australia, Pamela Munger in the UK, and of course Neil Atkinson from Paris. where there's lots of noise for European elections going on. Certainly going to be interesting to see how they turn out and what their ramifications for Europe will be. Maybe not too much for the oil markets, but maybe for Europe. Thank you, guys. Have a great day. Catch up with you all soon again. Bye-bye.
Thank you.
Thank you.